You know the number, the one you agreed to at the dealership, that monthly car payment. You've probably told yourself, it's just a normal expense, another bill to pay like the electricity or the water. I mean, everyone has a car payment, right? Right? But what if I told you that a single payment is the biggest obstacle standing between you and real financial freedom? What if it's not just a payment, but a silent wealth-killing machine designed to keep you working for your car instead of your money working for you? Most people have no idea how much their car is truly costing them. It's not just the payment, it's the invisible financial drag that follows you around for years. Today, we're exposing how your car payment is secretly sabotaging your future, and we're gonna show you exactly how much wealth it's stealing from you. Hi, I'm Emily, your big sister in finance and the founder of Sora, where we make personal finance clear, relatable, and actually useful for us figuring out life and money together. If this is something you're into, then hit the like and subscribe button and keep watching. Let's start with the oldest trick in the book, the monthly payment trap. You walk into a dealership and the whole conversation is laser focused on that one question. So, what kind of monthly payment are you looking for? Sounds innocent, right? You do some quick mental math, you look at your paycheck and think, yeah, I can swing $700 a month, without really having a clue what you can afford. But that question is a trap. It's designed to make you focus on that small reoccurring number and not the massive total cost of the car. Financial experts have clear guidelines for this kind of stuff. The 23-8 rule. You should put a down payment of 20%, pay it off in 3 years, and the monthly payment should be no more than 8% of your monthly income. So, if you take home $4,000 a month, your car payment should be under $320. Now, let's look at reality. The average monthly payment for a new car recently hit a staggering $758. For used cars, that was $532. Some people are signing up for the payments of $800, $900, or even $1,000 a month. When your car payment is that high, you're not just paying a bill, you are suffocating your budget. And that huge chunk of your income leaves no room for anything else. It's money that could have been your emergency fund. It's money that could have been invested for retirement. It's money that could have been paid for a vacation, a home project, or starting a business. Instead, it's just gone, vanishing every single month for an asset that is constantly losing value. And that brings us to the real silent killer in this whole deal, depreciation. Unlike a house, which usually goes up in value, a car is a depreciating asset. It starts losing money the second you drive it off the lot. A brand new car can lose 20 to 30% of its value that very first year. And after 5 years, it can easily be worth about half of what you paid for it. So think about it. You buy a shiny new $45,000 SUV. Oof, I know it's just an example, but my palms are already sweating just saying that number. Damn. Okay, so you drive it home, you show it off, you enjoy that new car smell, but then 1 year later, even in perfect condition, it might only be worth $36,000. You've lost $9,000. But here's the kicker. In that first year of your loan, most of your payments went to interest, so you've barely made a dent in what you actually owe. This creates a terrifying financial situation that millions of people are trapped in, and they don't even realize it. It's called negative equity. Negative equity, also known as being upside down or underwater, is when you owe more on your car than it's actually worth. And it is shockingly common. It's the direct result of that insane depreciation we just talked about, combined with some really common and really bad car buying habits. So here's how you fall into that trap. First, you put little to no money down. Second, you stretch the loan term out to 72 or even 84 months to get that lower monthly payment. The average loan term for a new car is now nearly 70 months long. That's almost 6 years of debt payments. Longer loans means you pay down the principal incredibly slow, all while the car's value is just taking a nosedive. But the most destructive habit of all of this is rolling over the negative equity from your last car. So let's say you want to trade in your car, but you still owe 20 grand on it. The dealership looks it over and offers you 15. That's $5,000 of negative equity. What do? They smile and say, no problem. And they just add that $5,000 you're short onto the loan of your brand new car. You literally just started your new loan already $5,000 in the hole. And that's before that new car even starts depreciating. This is how people get stuck into that debt spiral, going from one upside down car loan to the next as the debt gets bigger each time. You're trapped. If you need to sell the car, you can't, unless you have thousands in cash to pay the lender difference. If the car gets totaled, your insurance will only pay what it's worth, leaving you to pay off the rest of the loan for a car that doesn't even exist anymore. Okay, so this is where the true gut-wrenching costs of car payments become crystal clear. It's not just about the money you're spending, it's about the wealth you're not building. This is called opportunity cost. Every dollar you send to the bank for your car is a dollar that isn't being invested and growing for your future. So let's use a simple $700 a month car payment, a little bit less than the current average. A typical car loan is for 7 years. Over those 7 years, you will have paid the bank a total of $58,800. At the end, that car you bought is now a 7-year-old vehicle worth maybe a fraction of its original price. But what if, instead of sending that $700 to the bank each month, you invested it in a simple S&P 500 index fund? Historically, the stock market averages an annual return of around 10%. So if you invested the $700 a month for those same 7 years, with a 10% return, you wouldn't have a used car, you'd have over $86,000. By the time you retire, that's close to $2 million. So let's just be clear about the choice. After 7 years, you can have a used car worth maybe around $15,000, or you can have an investment portfolio worth $86,000. That car payment didn't just cost you the $58,000 you paid, it cost you the $86,000 your money could have become. This is how wealth is built and how wealth is ruined, and your car payment is actively stopping you from building that wealth. Is this hitting a little too close to home? If you're looking at your own car payment and feeling that financial squeeze, let me know in the comments what your biggest struggle with car costs has been. Sharing your story helps everyone realize that they're not alone. And while you're doing that, do yourself a favor and hit that like and subscribe button for more financial truths that the industry doesn't want you to know. Our goal here is to put more of your hard-earned money back into your pocket. Okay, so the problem is clear, but how do we fix it? How do you own a car without letting it own you? It comes down to a few tough but simple rules. Rule number 1, follow the 23/8 rule. This is a classic for a reason. Put down at least 20% down payment to fight off that initial depreciation hit. Finance the car for no more than 3 years or 36 months to build equity fast and pay way less interest. And finally, keep your total monthly payment below 8% of your gross monthly income. Rule number 2, buy used. Let somebody else pay for the biggest depreciation hit. The smartest move is often to buy a car that is 2 to 3 years old. It's new enough to be reliable, but has already taken that massive 30 to 40% drop in value. You get a great car for a fraction of the price. And if you want to buy new, a good goalpost to making sure if you have a net worth of $1 million first. Then you can start looking at those new cars. Okay, rule number 3, never ever roll over negative equity. If you're upside down on your loan, you have 2 choices. Keep driving it until your current car, until you've paid it down and have positive equity. Or if you have to sell it, save up the cash to pay off the difference. Rolling that debt into a new loan is financial suicide, and you're just kicking a bigger can down the road. Rule number 4, the ultimate goal, pay cash. This is the strategy of the wealthy. Famous studies like those in The Millionaire Next Door found that most millionaires don't drive fancy cars with huge payments. They buy with cash. This might sound impossible now, but you can work your way there, I promise. Start by buying a less expensive used car, pay it off fast, and then keep making those same car payments to yourself in a savings account. When you have enough, you just buy your next slightly better car with cash. Repeat this and you never have to have a car loan again. So I know that monthly car payment feels normal because the auto industry profits from making you think that it is, but it's not normal to trade your future wealth for a depreciating piece of metal. Your income is the most powerful wealth building tool. And when a huge chunk of it is diverted into a car payment, you are crippling your own financial progress. It's time to change the way we think about cars. A car is a tool to get you from point A to point B, not a status symbol you should go into debt for. By following the rules that we laid out, buying used, using short loans with big down payments, and ultimately working to pay with cash, you break that cycle. You stop making banks and car companies rich and start building your own wealth. The choice is yours. Do you want to own your car, or do you want your car to own you? Thanks for watching. Don't forget to like and subscribe, and I'll see you in the next one.